What up, investors? Have you ever heard the saying buy low and sell high? Ever wonder what that really means? How can you tell if the stock market is cheap or expensive and whether it's a good time to buy or sell? Well, one tool that professional investors like to use is called valuation. And one of the most popular valuation metrics is something called the price to earnings ratio, or the PE ratio. So today, we're going to learn how to use the PE ratio to help determine whether it's a good time to buy or sell in the stock market. Here's the equation for the PE ratio. It's simply the price divided by earnings. So in this particular instance, what we're going to look for is the price of the S&P 500 divided by all the earnings of the companies included within that benchmark. So Yahoo Finance is one of my favorite resources for stock market news and data. So I'm going to use this website to pull the pricing information for the S&P 500. If you notice here on the homepage, at the top left-hand corner, you see the S&P 500. You actually drill down a little bit further to get some additional details, and you'll notice that the S&P 500 is priced in USD, or US dollars, and this information is as of the close October 18th, which is this past Friday, or the most recent data available. And on Friday, the S&P 500 closed at $2,986. So that's the pricing information I'm going to use to plug into my PE ratio equation. So now what we do is take the price of the S&P 500, which is $2,986, and plug that into the numerator of our PE ratio equation. Then the next step is for us to identify the earnings number that we're going to include in the equation. And I find this website, Yardeni Research, a helpful tool when it comes to that. If you pull up the website, it's simply yardeni.com. This is the homepage. If you scroll to the right here, you'll see a search bar. If you click on that, it'll take you to a search function and just type in earnings estimates. And it brings you a couple of different options. What we want is this one here, the YRI S&P 500 earnings forecast. So we click on that. It brings us to a PDF report that says the S&P 500 earnings forecast. Let's check the date to make sure it's relatively recent, October 14, 2019. It is. If we scroll down, you will see what they have listed here. So here's the chart from the report we want to focus on. If you look a little bit closely, the table is divided into two major sections. The first is the Yardeni research data. The second is the analyst consensus data. And what we want to focus on is the analyst consensus, because that will give you the average expectations for the marketplace. And the way to read this chart is to scroll down, and you'll see the different time periods here, either by year or broken out by quarter. And for instance, in 2018, this chart tells you that the S&P 500 earned $162 approximately in earnings, and then it grew earnings close to 23% compared to 2017. And so you'll also notice there are letters next to some of the numbers, an A, and as you scroll down, you'll see an E. The A stands for actuals, and the E stands for estimates. So you have a decision to make here. Should you use the actual historical earnings of the S&P 500 or the forward-looking estimates? Both are correct, but my view and preference is to use the forward-looking estimates because investors in the stock market are generally forward-looking creatures. When we use estimates, standard practice is to use projections for the year out. So since we're already in October of 2019, it makes the most sense to look at the earnings estimates for 2020. So in 2020, the analyst expectation is for the S&P 500 to earn approximately $182. So if we take the $182 that the S&P is expected to earn and plug it into our PE ratio, we get a PE multiple of 16.5 times. So the market's trading at 16.5 times. Is that cheap or expensive? Well, to determine that, you actually need more information. You need to have a reference point, meaning you have to have an understanding of where the market has traded in the past. JP Morgan published a cool chart recently showing the historical trading ranges of the S&P 500 over the past 25 years. The chart goes back to 1994, and the way to read it is on the x-axis you have all the years, and then on the y-axis the PE ratio or PE multiple that the market traded at during that year. So for example, let's say 1999, at the peak of the internet bubble, the market was trading at a little bit over 24 times forward earnings. And if you look at 2009, which is the trough of the Great Recession, the market was trading at about 10 times forward earnings. I mentioned we needed a reference point in order to determine whether the current market PE ratio of 16.5 times is either cheap or expensive. Well, one good reference point would be the average PE ratio over the past 25 years. And JP Morgan indicates that the average over that time period is around 16 times. So you could say that the market really isn't cheap, but it isn't expensive either. It's what we'd call fairly valued and trading in line with the market average. So how can you tell if the market is cheap or expensive? Well, this is when the concept of standard deviation comes in handy. Standard deviation is a statistical term, and a thorough explanation of the concept goes beyond the scope of this video. But all you really need to understand is that it represents a meaningful divergence from the average. So when the market begins trading at these levels, alarm bells should go off in your head and tell you to pay attention. And as we can see in the chart, one standard deviation above the average is around 19 times. So that suggests that at these levels, the market is getting fairly expensive. And on the flip side, one standard deviation below the historical average is around 13 times. So that should tell you that if the market's trading at these levels, that it's meaningfully cheap compared to the historical average. So these PE levels represent good markers to determine whether the stock market is cheap or expensive. So if we put it all together, what we discovered today is that the market is trading at around 16.5 times earnings. And that is pretty much in line with the historical average over the past 25 years. So you could say that the market is fairly valued at the moment, meaning there's no real urgency to either buy or sell stocks. However, in the future, if the market begins trading at 19 times forward earnings, then you can make a really strong case that the market is expensive and it would be a good time to sell stocks. Conversely, if the market falls and begins to trade at 13 times forward earnings, it's a pretty strong case that the market's cheap and it would be a good time to buy. Okay, hope you found that video helpful. If so, hit that like button and be sure to subscribe so you don't miss any future episodes. Until next time, stay up and invest wisely.